Welcome to For Advisors by Advisors with guest host and CFP Nic Nielsen. Today I am filling in as host for the great Evan J. Mayer because our guest today is indeed Evan J. Mayer of Fortuna Wealth. Evan, welcome to your own show.
Thank you. Thank you.
How does it feel to be on the other side of the mic?
Interesting to be on this side and, speak the truth. So I'm excited.
And you have no idea what questions are going to come at you, so that
I don't.
So that makes it a little bit of fun. So I'll set this up a little bit. So Evan has 20 plus years of industry experience and has all the cool credentials behind his name: CFP, CRPC, and CWS. Did I miss any, Evan?
You actually did. There's a funny one called the CMFC. I think it's Charter Mutual Fund Counselor. And it was right after I got my CRPC. I'm like, what's another easy one to get some extra letters behind my name? And there was like this real easy one called the CMFC. And it took me maybe 4 days to study. I think I took the test like within 6 days of signing up. And then when I affiliated with my new firm, they're like, yeah, we're not going to let you use that. So I dropped it. And, once you get your CFP, I guess all the other credentials are kind of,
you always lead with the CFP, right?
You do.
That's the most critically acclaimed one. So one of the things, over the last 3 years that I've been just dying to know, and I've been lazy, is what is Fortuna all about? So I Googled it this morning, and I found out that Fortuna is the goddess of chance, luck, and fate. Is there anything additional that I should know about that, or how you came to the name Fortuna Wealth?
So interesting enough, when I went independent, I decided to make my name something very similar to where I was. So I was the Mayer Group with SunTrust. And when I left, I wanted to be the Mayer Group with a big name behind me. And so the company I affiliated with, I decided just to keep my company name as the Mayer Group. And it allowed for clients to understand that the transition was going to be seamless. It was going to be us. It was going to be our same kind of unit. And as I was starting to recruit people to potentially come over and join, I was getting a lot of pushback with, can I use my last name? And if you've ever go to like doctor's offices or lawyers' offices, they have 4 or 5 different names. And I didn't want to do that. And I decided to create a name that was cool, easy. I didn't want a really long website name. My website was themayergroupfinancial.com, and having to spell that out for people was just a pain in the butt. It was. Yeah. It was. And so Fortuna Wealth just made a lot of sense. It was available. I was able to buy it. I think I ended up spending $5,000 to buy it off the person that had it. It was short. It was easy. It stood for good luck in Italian. So I thought that was really neat. There's a Greek goddess of fortune named Fortuna. So thought that, worked well. And I had my graphic designer create the logo. And within a month, we had the name and the logo and everything kind of picked out.
It's a great looking website too. Clean, colors are nice. It all flows well. You have a nice suit jacket on in the picture, so you're all buttoned up, clean shaven, looks good. So Fortuna, goddess of chance, luck, and fate. Maybe it was a little bit of Fortuna that brought us together when we were at SunTrust. So you were at SunTrust for 7.5 years, March of 12 to August of 19. One of the questions that I always love to ask bank guys, what do you think the keys were that made you wildly successful at building a bank practice?
So I would say your biggest client or your biggest referral source is the bank. Okay. And so your biggest client technically is the bank and the bank's employees. I worked in the bank channel since 2005. So realistically, I had that time at SunTrust, but I had also that time at Bank Atlantic. And during both of those banking experiences, it was the time you spent with the tellers, the personal bankers, the bank managers, getting them to know you, getting them to know that you're going to take care of their clients, that you care about their clients, aligning yourselves with what their goals were and their needs were, along with yours, so that you were able to reciprocate referrals back to the bank. So during that time, it was all about sitting with them, having lunch with them. I remember we used to do quarterly dinners for all the branches I covered. We would get wholesalers to pay for it, and we'd all go out to Chili's or Ale House, or maybe if we had enough wholesaler support, we could even do like a nice steakhouse or something. So it was all about building the relationships in the bank to get those relationships sending you referrals. And I remember at Bank Atlantic days, we had a little button that used to say, "You want a higher rate? Speak to Evan." And so people would go, who's Evan? The teller line, So we had cool little things that we did like that. The biggest thing in the bank world is understand that you're in a political environment, play the game, do right by the bank, do right by your clients, do right by the people that are referring you business, and make sure that branches are getting credit and coverage and all that stuff. Don't be cheap. Be very, very open with your time. Be very engaging with everybody. If you work the bank hard, and that was, again, I don't know if it would still be the same today. I've been talking a lot about that on the show over the last 6 months. I've been running the podcast. I think the bank channel is no longer what it was. But to me, that was a humongous advantage. And so referrals, we never needed referrals from existing clients. When the book got to a size where now almost 50% of the referrals were coming from the book, that's kind of when the decision, how important was the bank? Do I still need to be with them? Is it now time to branch off because I'm getting enough referrals from the existing book to go independent? And that's when I made that decision.
Yeah, it's kind of that tipping point. Do you feel that you had some like instant credibility because you started in the bank? I mean, you started as a licensed banker. Do you think that gave you some additional credibility that you had, walked the walk and that you had been in their shoes to some extent?
Yes, with the bankers, yes. Specifically at Bank Atlantic, because they knew I was a licensed banker. When I moved to SunTrust, I was already an advisor. So I don't know if that played such a key role. It played a key role in my understanding of what the bankers go through. I mean, at the end of the day, most tellers and personal bankers don't make big money in the banks. Okay. Rules of advice were always don't drive the fancy car to the office. Don't showboat because you're going to be making better money than them, and to put yourself on their level. And I think when you work in the bank, it's important to do that initially until they know who you truly are. When they know who you truly are, it doesn't matter what you try.
Yeah, once they know your character.
Once they know your character, they care. So that was a huge advantage of being in the bank, is that I did come from it. They understood who I was. I understood who they were. And so relatability is extremely important.
So I want to focus really on what happened after you created your own company, because I think that's really the exciting part. And I think it's almost the gold standard in the industry today. Is I feel like whether you're in the bank or the wirehouse, those are wonderful places to have a career, and they are careers for a lot of people. But for many, they are stepping stones to ultimately get to the top of the mountain, the pinnacle, which is owning your own company. Having true equity of ownership in a business. How important was it to you to own the business?
Initially, it was not. So when I decided to start looking, the announcement came that BB&T was buying SunTrust, and I had gone through a buyout with Bank Atlantic. And truth be told, it was some of that old buyout that happened with Bank Atlantic that kind of made me move a little quicker than I normally should have. Hindsight being 2020, I probably had a little bit more time, but I decided to look, and I knew my practice was successful in the capability that most of it was fee-based, that everything was financial planning based, and that my mandated clients had plans. I mandated I needed to know a lot about the client before I move forward with them. It was interesting in a bank channel to do that, by the way, because it was never done prior. Any of the other bankers that I had worked with had never worked with an actual financial planner. It was always a mutual fund sales guy or annuity sales guy or whatever it was. And so when I started to look, the wirehouses were offering big checks, okay? And we're talking 7-digit, checks, mid 7-digit checks. So big money for somebody that's, at the time when I left in August of 2019, I was just turning 39. I was 38 the day I resigned. So I was young, and to get that kind of check would have been a game changer. But as I went through the process, I ended up meeting with Joe Pellegrini, had a steak with him. Still remember to this day, he's like, there's a little bit of a budget. And I remember being like, budget? These guys are offering me 7 digits. We're talking about a budget. And as I explored down the independent path, I realized, and he had introduced me to a few different OSJs, and some of them were fully turnkey, some were partial turnkey. And for those that are listening on the show, turnkey means, like, when you go independent, you really make a decision on how much you want to control and how much you don't want to control. You're back to your question of, was being a business owner important? Initially, it wasn't until I was. And when I went through the process of taking care of my own lease, my phones, my payroll, And then I realized that I outsource all of that. So I actually have a payroll company that does all my payroll for me. And it's on automatic. So anytime I want to give a pay raise, I got to go in there. But other than that, pretty easy. The phones are on auto pay, pretty easy. The rent's on auto pay, pretty easy. Since I started the show in August and I've interviewed a lot of people always go, you got to have an entrepreneurial background or feeling. You don't necessarily. It's really up to you on how much time you want to spend on your business.
So we think about 3.5 years ago, you went independent to where you are today. What has surprised you the most about going independent?
Just the freedom and flexibility of doing what I know is right and never worrying about conflicts of interest. In the bank, I would get pushback. We did an interview with Kevin McCarthy, which is not out yet, but we were talking about on that show, we talked for a few minutes about incentive manipulation and some of like the goals that these bankers had to have. And you play the game to the level of that it's in the benefit of the client. But what I started to notice after my last 5 months in the bank is that stopped happening as much. It was all mostly focused on goals. And to not worry about making sure people get credit that maybe don't deserve credit or not being pushed to do things like, can you make sure you speak to Mr. Johnson about the line of credit and the credit card? And you go, he doesn't need a line of credit. He's got a line. It's a perfect line. You don't need to refinance him. He's fine the way he is. That was huge to me. That was a big relief moment.
Or it's the opportunities that you didn't know about in real time, right? Someone comes in with a $500,000 check and they're not going to tell you about it because we want to put that in a money market and get credit for new money. And they're going to plant the seed. Hey, in 3 months, we want to introduce you to Evan, but for now, let's just get the money in here. And that money may or may not be there.
I forgot about those. Yeah, there was a bunch of those too. He didn't want investments. And it was always like, how did you ask the client? Because if they want, the bankers would do this. If they wanted the client to invest the money, they could go, well, I could put it in a CD, but Evan could probably get you 2 or 3 times that. You should speak to him. He's got a lot better options. And then the converse, if they wanted to keep the money in deposits, they would say, we do have a guy named Evan that does investments that, have a lot more risk. But if you want your money safe, then I can help you with the CD. And it was just how they said it on how it would manipulate the situation. Instead of saying, Mr. and Mrs. Client, what's important to you? What's the best way we can actually help you? And I started noticing that a lot. And it's funny you bring that up.
It's just funny that all of that best interest stuff only applies to financial advisors, but it doesn't apply to people that within the financial services industry,
And I don't want to paint a brush, right? Because
no. It happens. Yeah. Not everybody is like that, but it definitely happens. And then, from our standpoint as advisors, if somebody needed a mortgage, SunTrust, any bank, not SunTrust specific, your bank may not be the best for that person. There might be other institutions that have better deals for dentists or whatever. If somebody did need a credit card, maybe your bank that you're working for has an inferior product, an online bank or whatever the case might be.
Yeah, and just to hop on that real quick, you're 100% right. And just speaking, the 99% of the people I worked with in the bank channel were not that way. But if it depends on who's in the role and who's leading that role is an important thing. And then 2, yeah, SunTrust was, speaking of them, they were competitive in mortgages and things. But as you said, sometimes there's private trust accounts at a regional bank or a trust bank that's able to get the client 1% less because they might keep assets there, and we can help facilitate that. I think that's a huge benefit.
Yeah, absolutely. We're not tethered to any financial institution as a independent financial advisor, right? I mean, you're removing as many conflicts of interest as you possibly can.
For sure.
Thinking about where you're at versus where you were and what you've learned over the past 40 months or so, what do you wish you would have done differently?
I rented a printer. I talk about this in one of my episodes. At my old firm, they were not up on DocuSign. They were kind of getting it, I think, when I left, but it wasn't for everything. And a lot of things you couldn't do. And I rented this darn printer, and I finally got done with the lease about 4 months ago. I'm happy. There's a lot of things that you get, I guess, you regret. First of all, when you leave, you got to leave like the Baltimore Colts left Baltimore. You got to leave for those non-football fans, they literally left in the middle of the night, right? You kind of have to leave that way. You resign that day, and you got to be on the phones that day with your clients because the bank is going to be on the phone with your clients as well. And it's a race to see who has the relationship. And when I left, my book of business was passed out between about 8 advisors, and there was a phone call, and I was told about this call from 2 of the advisors that were on it, that hey, Evan was a good advisor, but he went independent. He's going to not be able to spend much time with clients because he's going to be too busy, owning his own company, and that he doesn't offer some of the things that were there, things along those lines. And again, that was nothing I could have done different. So I know that was your initial question, but I remember as
Yeah.
I was leaving, just, unfortunately, when you leave, the relationship is never going to be the way it was. And so there's not much I regret other than the printer and the way I had to leave.
Now, if you think about the success that you've had over the past 3 years, if you duplicated that same success over the next 3 years, would you view that as a win?
Yes and no. I'm at a point in my size book of business when you cross the 200 million, 250 million mark and you're managing a specific amount of households, you get to a level where you know that if you take on X more, you probably can handle it. But if you take on X more than that, you can't. And I'm at a point now, starting actually in January, we're going to be hiring 2 financial advisors, salary rolled financial advisors with incentive payout. I got a couple good ideas from Kate Clark on here and from Joe Conroy on structures that they did. And so I learned a lot from these interviews on a way to compensate them just on AUM. So it's no longer about revenue focus for them, but it's focused on bringing in the clients the right way. So for me, what in 3 years from now, I would hopefully be looking back at roughly the same size individual practice, but as a firm under Fortuna, to have double the amount of assets with 2 or 3 or 4 other advisors managing assets and managing plans. That would be the win.
Do you foresee, thinking about the future, do you foresee that you will become that wise sensei mentoring over young salary rolled advisors, or will you bring in someone to manage the asylum?
No, I like coaching. It's actually me and you had talked about this in the past. When SunTrust at one time was paying us to go around and do some of these speaking engagements, which was excellent because we were actually getting paid for our time. It wasn't nearly what we were getting paid to sit in front of clients, but I didn't care. I looked at it as a free trip and they're paying me and I'm having fun. So same reason I'm doing the podcast. I don't do the podcast because I need the money. I don't do the podcast because I need referrals. Specifically, I don't want clients to listen to my podcast. I've had 1 or 2 people go, "Oh, I heard your podcast." And I was like, "Oh, well, I really don't want you to listen to that." Because it's really, to me, it's more of a fun scenario situation. So for me, I like teaching. I don't think you need to be 60. I think we're at a good age, Nick, where we know what the 60-year-olds per se know, but we also know what the 25-year-olds and 30-year-olds are going for. So, I mean, now if you're telling me that we end up bringing in 20 different advisors, then maybe I would need somebody to do that because then I'm working a little too hard. But I think
Sure.
at the end of the day, creating the ideas of contacting your clients, what you're doing for planning, are you doing planning in front of the client, which I think is a tremendous thing that every advisor should be doing nowadays that I don't think is done enough. I think that stuff has to be done a specific way, and I do want to be part of that.
Yeah, that's really cool. I love the idea of financial planning. We'll just call it with clients, right? It's that live sort of education and being able to respond to the what ifs. What if we retire 2 years earlier? What if we took out an extra $1,000 per month? It's so great to be able to respond to those things in real time and show them, how the sausage is made. I
The
think that's
fact that
really powerful.
it not only is it powerful to the client, but the fact that you understand how to use the software and the client can envision the cash flow report, making those adjustments and how that affects things and can see how you're able to orchestrate and use that. Their confidence in you and an advisor is going to go up. Their confidence in themselves and their plan is going to go up. And it develops a relationship that has nothing to do with the X's and O's on how you invest their assets, but more on what their goals, wants, and wishes are. And are you on board with what they're thinking on top of what you're recommending?
Selfishly too, I think when you can do that, that instills a certain level of confidence within you as an advisor. And a confident advisor is going to be a better advisor because a weak advisor is never going to instill that confidence in a client.
For sure.
One of Your growth metrics are awesome. What do you think have been the key drivers for growth for you and your practice?
Everything that I've done in my practice, the hours that I've spent in financial planning with clients, specifically on the front end. I don't charge for financial planning. I know that's a waste of some people's time. I don't charge for per hour or per session. I know that's a waste of some people's time. But that first 3 or 4 hours spending with a client, not talking about investment management, but more talking about the X's and O's of what's important to them, that's what's made me successful. And now, as the relationship continues to grow and the management of assets are up to their expectations, the planning is up to their expectations, far exceeds their expectations. And then the amount of time that you're with your clients, right? And you meet your clients once a year. That's only one opportunity for their friend to say, hey, where are you going? I'm going to my advisor, instead of 4 times a year. Even if the meeting's 20 or 25, 30 minutes. I think points of contact are extremely important. Client education dinners, client appreciation dinners, phone calls on the birthday, at least an email on the birthday out to them specifically, talking with them about their lives, what's important to them, emails, video blogs, communicate. Don't send the same generic crap. I can say crap. I don't have to worry about it.
Your
Don't
podcast, you
send,
say whatever you want to.
yeah, don't send the same crap out there. I remember at Sun, you would send out that systematic email and you go, oh, nobody likes that email ever. Why? Because nobody's reading it.
Right.
Nobody cares about it. And it's something I think you do a phenomenal job at. And you use LinkedIn more than I do for prospecting purposes. I don't use it for that because I use it for the show. But it's that stuff, the passion, and then showing the passion when you're with people is what gets you to be successful.
I, and correct me if I'm wrong, but I feel like from the things that we've talked about, your growth at what I would consider has all been like organic or primarily organic, right?
100%.
It because you haven't really taken a part of any like major marketing initiatives or joined Dave Ramsey's Smart Vestor Pro or Wiser Advisor. Or,
So I don't
talk a little
do,
bit about kind of your
yeah,
theology mindset around marketing, if you would.
I don't have one. I don't do
And
any
that's the key to
seminars.
success.
I don't do any seminars. I don't go on. I don't go on recruitment trips. I don't join BNI. I don't join these groups. I work on my existing book to the extent that they're family, and I do not ask for referrals. That's also another no-no to some advisors. Don't. You should ask for referrals. I think it's corny. If you're really good, like I go to a chiropractor. His name's Todd Rodman. Right. Anytime I have an injury, he comes and I go see him for 20 minutes and he works on that injury. And he doesn't just crack bones. He's not that kind of chiropractor. He's like sports management, more muscle and tissue. And he does such a phenomenal job that for the week that I leave him, right, I'm out there saying, oh man, I went to go see my chiropractor. He's phenomenal. He was phenomenal. He's phenomenal. He's phenomenal. Somebody goes, oh, my hand's hurting. I go, you got to go see that in Todd Rodman,
Right.
So,
Yeah.
so that doing the right thing, you don't need to go out there. Now, some of you can say this, and it's probably 50% true, that I have a big enough book of business that I don't have to do that. And so you're lucky, yes, but that's
You
what,
also grew it without the marketing, though. I mean, you weren't just blessed with this huge book of business. Like you grew the whole thing.
yeah, when I came to SunTrust in 2012, I had $10 million in assets. That came with me at the time. I was newer in the business, halfway through my career, but not really new. I didn't learn a lot then. My business then was promoting through the bank, and I was really good at that. I was really good at dealing with clients. You got a client in front of me, I was able to close them. So the closing ratio was always significantly higher than anybody else in the area, where we had other bankers that were like, hey, we really want to get Evan involved in this. So it was a great situation. I definitely lucked out there. I worked hard, Nick. There's zero doubt about it. Every night I was completely exhausted, but in no way, shape, or form was it just given to me. And I didn't buy a book, so there was no. So I mean, I guess that's 100% organic.
Yeah, you earned every one. Nothing was handed to you. And I think what you're talking about is really describing what I would call the experience economy, and that you've grown your book really through just surprise and delight and just exceptional execution on financial planning and being a good guy and doing what you say you're going to do.
Yeah, I fully agree there.
Evan, one of the things that I think is really cool about what you're doing in a world where the investment management has kind of become commoditized to some extent, you've really kind of went the opposite direction, which I think is really cool. If you would talk a little bit about some of the things that you do that are a little bit different, maybe than a traditional boilerplate ETF model. You mentioned covered calls briefly earlier. So, question one, are you still using covered calls? And then talk a little bit about your use of structured notes. And then if there's anything else you're doing on top of that.
Yeah, so I'm pretty much 100% discretionary at this point. I would say out of 700 accounts or 160 relationships, I would say maybe there's two or three that are not done on a discretionary basis. So the way I manage money is I open up two accounts for every account title. So if there's a Roth IRA, they're going to have an equity account and they're going to have a fixed income and alternative account. If they have an IRA, they're going to have an equity account and a fixed income and alternative account. If they have a trust account, same thing. So every account title that we have has two accounts. I use Riskalyze, which is in my opinion, it's the greatest risk software out there, just in how it details what risk actually is. And it has more to do with volatility than if it's a stock or a bond. Okay. So I always thought like Money Guide Pro and eMoney and some of these risk softwares, I just think they're outdated at this point. Riskalyze is, in my opinion, that's the new way to determine risk. And the equity models, I run three different strategies. One is our main equity strategy. That's really going to be for clients that are in the 6-digit to 7-digit to 8-digit space. There's anywhere from 70 to 85 different stocks in there at any given time. My allocation is anywhere from 0.5% up to 3%. I rarely go up to 3. It's mostly in that 0.5% to 2% range. And those are all individual equities. I believe that a client knowing what they own and seeing the actual positions gives them a level of comfort that will far surpass any type of extra alpha that they're going to get inside of a mutual fund wrap or an ETF wrap program. And the reason for that is if I know I own Johnson & Johnson, Coca-Cola, McDonald's, Starbucks, Google, Apple, I can keep going. And these are all great companies. They're great companies that I own, right? And I see them on my statement. Whether my balance drops by 5 or 10% isn't going to be as big of a drop than it would be if I own something I completely don't know I don't understand what I own. So I think knowing what you own is extremely important. I do believe in ETF models for clients in the right dollar amount. If they got $5, $10, $20,000 to their name, you're not going to be able to diversify them properly in between stocks unless you're Jim Cramer and you only believe in investing in 8 to 10 different stocks, which I don't. I want my portfolios to keep up with the market, maybe beat the market, but not underperform the market significantly. And the way to do that, I think, is to diversify properly. Structured investments, it's a huge part of my business. So what I do on a risk analysis standpoint is the first thing I know long-term is that stocks should outperform the other asset classes. And historically, that's what they do. Stocks outperform bonds, they outperform structured notes, they outperform alternatives. So when I mitigate whatever the risk is going to be, that percentage that I know I can get into equities is the amount that I put into equities. Then the next step is structured investments. Do I have clients that can understand them? I walk them through it, how it works. I educate them on the secondary market, what they're looking like on their statement. And then when I go out and I reallocate the structured investments based upon their asset size, I diversify those too, not only between the sectors that it's investing in, but also in maturity dates and also in the investment bank. I want to diversify the banks. I want to try to remove default risk, or you can never fully remove it, but diversify it enough away. Diversify the maturity date risk. If you had all your structured notes maturing in March of 2020 during the pandemic, that would have been pretty bad, all right? But if you had structured notes that were coming due in March, April, May, June, July, maybe your loss would be significantly reduced. So I love individual structured investments. The buffered ETFs for structured notes, those work. The problem is you don't have an actual date of maturity and it rolls over at whatever the current rate is. Maybe I want to wait 2 weeks. Maybe I think the VIX is a little low and I think volatility is going to really increase in a couple of weeks. I may want to wait. And with an ETF, you can't really do that. So I'm not against people getting into them using the ETFs. But personally, and due to the size of the practice, I'm able to do the individual ones. And I also do bond ladders, individual bond ladders, no bond funds. Any clients that owned a 60-40 portfolio this year got hurt. Any clients that had a 60-40 portfolio but had bonds that were laddered from 1 to 3 years really didn't get too hurt. Their
Right.
portfolio went down, but not nearly as dramatic. So
And even if they went down on paper, they can still hold those bonds to maturity, right? I mean, that's the beauty of the ladder.
yes. And for clients to understand that their portfolio is going to have stocks that we know are going to fluctuate on valuation, interest rate, everything else, but we know what we own. We own solid, good stuff. And then on this side, we have maturity dates. On the structured notes, we have some downside protection as long as they're underneath the barriers at maturity. And then we have these bonds that, again, when I'm buying bonds, I'm not a junk bond buyer. All right. I'm buying specifically now, you can buy treasuries right now are keeping up with the corporate bonds. So laddering treasuries, laddering corporate bonds, and Campbell Soup and Johnson and Johnson and McDonald's and Disney and companies that you feel are pretty going to be around in a year or two from now, feel pretty confident about, I think is just a great way to diversify your assets.
And I think that's such a refreshing story, I think, for clients to hear. They love that level, I think, of expertise that you're putting into it, as opposed to, hey, we're just going to buy these 3 index funds and call it a day. Because I think to your original point is I think clients exhibit better behavior when they know what they own, why they own it, and where it fits in to their overall financial picture. The industry today, there's no shortage of information that we have access to at our fingertips. Are there any people that you really enjoy just reading their content? It doesn't necessarily have to be analysts or anything like that. Like for me, I'm a huge Nick Murray guy. Like just reading his stuff pumps me up. Is there anybody that you really like warms your soul?
Yeah, Nick Murray's great. First of all, love him. I'm a big fan of. I like listening to some of the guys on CNBC, their thoughts, specifically during the pandemic. Tom Lee, yeah. So anytime I'm like, God, this market's killing me, I just need a little pump up. You put a little Tom Lee on, he'll tell you why everything's going to be okay, based upon the mood you're.
He is the ultimate bull. He's fantastic. He's got, I think, like 10 reasons to be bullish in 2023, which are fantastic if you haven't had a chance to look at that yet.
He kicked butt in 2020, kicked butt in 2021. He probably got hurt pretty bad in 2022 with every recommendation being wrong. But that's the thing with recommendations and money managers. I'll tell us a great story. There's a fund out there. You should look it up. It's called the CGM Focus Fund. I think it's CGM Focus Fund. And there's a book called Stay Mad by Jim Cramer. And in the Jim Cramer book, he mentions about 10 mutual funds that he would highly recommend. And there's a guy named Richard Hebner, I believe is his name. Again, could be pronouncing this wrong, that ran the CGM Focus Fund. And I remember when that book came out in 2007. And if you look at his Focus Fund's performance from 2007 to 2008, the average rate of return on that fund, you want to guess what his average rate of return was on that fund? He made 19% a year during that time. Okay. 1997 to 2007. Okay. 97 through 2007.
07. Okay.
Yeah. 2007. Yeah. 07. So 97 to 07, he averaged 19% a year.
Okay.
The average investor in the fund, do you know how they performed?
Abysmal, because they bought all the highs probably.
Yeah. So the average investor lost 5% a year. And the interesting thing about that fund is it was the best performing fund on Wall Street. He was a guy you would absolutely want to listen to every day. And in the 10 years since then, from 2008 to 2018, he was not only in the bottom quartile almost every year. I think his performance in this bull market was like down 2%. It was abysmal, the performance. So
Morningstar now has it as a 1-star fund.
It's a 1-star mutual fund now, and it was a 5-star by far mutual fund. It was the best mutual fund on the planet back then. And same thing with Cathie Wood. Cathie Wood was the darling of the world. Everything she said made sense until it didn't make sense. So I don't get too stuck on one person's thoughts on the market. I like Josh Brown. He's entertaining, and listen to some of those guys on CNBC that have their thoughts and their opinions. I think at the end of the day, you don't have to necessarily take anybody's advice. You can go out there and look in the market and say, what is of good value today? What's a company that I want to own 3 to 5 years from now? As Warren Buffett says, if I buy Geico and it drops a little bit more, then I look at that as a buying opportunity because I didn't buy it too early. It just gives me another opportunity to buy in more at a cheaper rate. If you believe in the companies you own, you believe in the investments you own, then own them.
Exactly. Yep. And with the people that you're working with, you don't put short-term money in equities, period. Right?
When you say short-term, I want to make sure we're on the same page. Short-term means 3 years or less.
Correct.
Correct.
Yeah. Yeah, we're
Yeah.
not talking about we have a down payment on a home in 6 months. We're going to put that in.
Tips. So most likely treasuries right now is probably what I would
Sure.
buy. The individual treasuries I would buy, or corporate bonds, or I would tell them to keep it at Capital One. Capital One pays 3.3. Ali Bank pays 3.3 from what I see. No, I don't invest anybody's money in equities unless there's at least a 3-year plus time horizon. If there is a time horizon of 3 to 4 years and they're going to use all that money to buy a house as an example, I still won't put a lot in equities. I'll lean more
Sure.
towards structured investments. You can get a structured investment tied to the S&P that has a 50% downside protection over the next 3 years that pays 8% a year. Are you going to beat 8% a year in the market the next 3 years? I don't know. I don't know if I will. I don't know if Tom Lee will. I don't know who will, right? But so I would probably lean a little bit more towards structures in that 3 to 5 year period, and then 5 years and out would be obviously more equity looking.
Right. Unhedged, get the most upside potential. Evan, is there anything that you had hoped to share with the audience that you didn't get a chance to?
I would say the one thing for advisors, specifically for this podcast in general, is feel free to ask to come on the show and share some cool stuff. I think we look at this lately. I've been interviewing some people that are part of groups. I talked a little bit about like there's women's groups and veterans groups and all these different groups that are out there. We're all advisors. We all go through pretty much the same thing. We have different issues than the next advisor, but at the end of the day, this is a great open forum. We never had a good open forum. I know there's other good podcasts out there, like Michael Kittis does one and Josh Brown does one, but it's not advisors talking to other advisors, talking about what they're doing in their practices to make practices better. And come on the show, share information. What I've always learned about sharing is the more you share, the more other people are going to want to share with you and tell you about what they do. And it's not about picking up a significant amount of knowledge. It's picking up that 1, 2, or 3 things that are absolutely great, right? Or if you disagree, and I do this a lot on the show, I'll say this person believes this way, I believe this way. Tell me, am I right or are they right? Like, why? Be inquisitive and never stop learning.
Evan, what's the best way to get a hold of you? Just send you a DM on LinkedIn?
Yeah, send me a DM on LinkedIn. I've never recorded an episode I have not aired, though. There's been a couple I've considered shelving, as we've talked before. And there's nobody that's ever asked to be on the show that I've said no to. I have had conversations. I did have one person who came on and I thought he was just going to be very critical to non-RA owning advisors. And I thought it was going to be spun wrong and didn't think it was going to be beneficial to the audience. So I decided to not go forward with that. But yeah, if you want to be on the show, reach out to me. My email is evan@fortunawealth.com. You can always reach me there as well. I'm happy to answer questions. Love this business. Love everything we do here on the show, and love that it's a constant process of learning and it never gets old.
Evan, congratulations on your first year hosting a podcast, 40 plus interviews in a short amount of time, in 4 months or so. That's amazing. I wish you continued success. I appreciate it, Evan. Hopefully a prosperous 2023 and beyond together, sir.
All right. And hopefully everybody enjoyed the show, and hopefully you join us for the next one.